You've got no idea what's coming. The US economy is flashing red warning signs for an imminent recession, and I think it's time we started paying attention. Investor George Gammon pulled the curtain on some of those signs, and I need to take a deeper dive into them so we know what to expect in the coming months. Obviously, this is not financial advice, but subscribe to the channel for more discussions like this. Let's get into it.
Several of the world's largest economies are now in recession.
UK, Japan in recession. Germany's probably next.
China's economy is suffering from deflation.
So we have to start asking the question, could 2024 be worse than 2008? I'm going to explain this to you in 3 simple, fast steps. Step number 1, let's go over this global recession that we're likely entering, or maybe we've already entered. Now, I know a lot of you right about now are saying, George, what are you talking about? The stock market is at all-time highs. The unemployment rate here in the United States is almost at all-time lows. Okay, fair point. We're going to get to that in just a moment. But before we do, let's take a look at how the global economy works. And yes, this is a simplification, if you couldn't already tell. So I want to point out initially that the global economy is very interconnected. All right, we've got the United States right here, obviously. We have the UK, Germany, China, Japan. Okay, well, right now, Germany is in recession. In fact, the whole Eurozone is most likely headed for recession. We've got China that is reporting outright deflation, the worst deflation they have had in decades. Now, officially, they're not in recession yet, but tell me how a modern day economy can have quarter after quarter of deflation and not eventually go into an economic contraction.
Now, all of the large manufacturing hubs in the world, I think one nation that is very closely tied to the American economy is China. It's the world's largest manufacturing power by far, and the second largest economy by GDP. And the thing about China is that at least since the 1990s, it has been growing at a massive rate of nearly 9% per year. The growth means 2 things for America. Firstly, that China, as the most world's populous nation, was the largest market for American products, and inversely, Chinese goods made their way to the US in a large influx of satisfying the demand at home for things like technology, plastics, and woodworks. But the problem now is that China, as an economic engine for the world for the past 3 decades, has started slowing down. The market and the manufacturer that was growing at a staggering 14% in 2007 is now struggling to maintain a growth rate of 3% today, and that was always expected because it's easier to sustain a fast rate when there's a lot of headroom left to grow. While the trade and tariff wars with China are a major cause of that, there's also other nations as part of a global economic slowdown that are triggering fears of a recession in the United States.
We have to recognize that the 4 main economies for manufacturing would be China at 28%, United States at 16%, Japan 7%, Germany 5%. Now, these statistics are from 2018, but the percentages might change slightly, but the 4 major players are still going to be the same. So let's think through how this works. China exporting goods to Japan, Japan exporting goods to China, China exporting goods to Germany, and Germany doing the exact same thing. And even with the United States, we produce way less than we consume. We still export a lot. So it's a similar type of relationship where China exporting a lot of goods to the United States, but we're exporting goods to China, UK. It's all interconnected. So what happens is if Germany, China, Japan, UK go into a recession, well, that's going to impact the demand for all of the people that we're exporting to. That means our exports go down. So what likely happens to our GDP?
And here's where the rubber hits the road. The sector of the US economy most likely to be impacted by a slowdown in these 3 major economies is agriculture. China's by far the largest buyer of American agriculture products and has its supply chains immediately tied all the way to American farms. And if you look at some worrying charts, American agriculture exports have seen a consistent drop over the last 3 years, mainly driven by lower orders from China, down from 59% of total cargo to 38%. And then on top of that, another great economic power of the East, Japan, has been going through a deflationary cycle for some time now, and the slowdown of the Japanese stock market and recent raising of their interest rates has shown its ability to crash the markets all the way in America last month. This means that a recession in places like China, Japan, or even the UK could very quickly lead to a contraction in major export-dependent sectors inside the United States, but that's not all, because if such a thing were to happen, prices would rapidly have to fall at home to increase consumption and absorb the produced goods. That would leave sectors like agriculture in a precarious position that could possibly need government assistance to keep from failing.
All the stuff that we are exporting is a surplus. In other words, there's not enough demand for that stuff in the United States of America. Let me give you a specific example. We export a lot of food. Let's just say corn and poultry and chicken. So I don't know that anyone would argue that Americans can eat more than they already do. I think they eat plenty as it is. So if we didn't have these customers, let's say in China, buying our chicken and buying our corn, could we just sell that right into the United States at the exact same price? No. We might be able to get rid of it, but we'd have to reduce the price, decrease margins. If we decrease the price, what does that do to nominal GDP? Brings it down. But that's not all. Let's look at it from the flip side of the coin. Like we said earlier, the United States does export a lot, but we import way, way, way more, which is why we have these massive trade deficits. Okay, well, if Germany is going into recession, China depression, all of this economic activity is decreasing, what that means is there's probably going to be a lot of entities that will go bust. A lot of those entities are providing goods, the goods that we consume here in the US.
We saw something similar in 2008 with government bailout programs worth billions that halted the dominoes from falling after a certain point in the banking sector. Unfortunately, that's a tough choice that a government could be forced to make in times of a recession, but that would also mean greater government expenditure, higher taxation, and money printing, and eventually the load falling on the people's pocket. It would be a choice between long-term pain or the short-term pain of letting industries fall and get back up on their feet. And it seems like investors are also anticipating such a scenario since the yield curve on U.S. Treasuries has been inverted for a few months now, signaling that investors are less hopeful in the short-term yields on Treasuries than the long.
Most of you guys know from watching my videos, the yield curve, and we'll focus on the 2s and 10s, has been inverted for over 2 years. And usually the stuff doesn't hit the fan, in other words, a recession, hard landing, financial crisis, etc., until the curve is no longer inverted. In other words, when the curve starts to uninvert, that's when you usually see the big problems that the inversion was predicting to begin with. So what's fascinating is what happened just the other day with the 2-year and the 30-year Treasury. Let's shoot right over to my Twitter feed because I took snapshots of both because this is a really big deal. We start off by looking at the 2-year Treasury, which was at 4.457%. Okay, well, let's look at the 30-year. The 30-year, 4.462. So the 30-year Treasury was trading the yield slightly higher than the 2-year Treasury. This is massive because it shows us that the yield curve is starting to uninvert.
All this makes for a scary picture and a glimpse into just how fragile and interconnected global markets really are, but in the case of a potential recession, all we can do is hope that lessons from the past would be learned and implemented to avoid the long-lasting damage that a recession can do. And while that may mean economic pain in the short term, perhaps it's worth strengthening the economic guardrails for once that can prevent a slowdown of other global powers from also slowing down the US economy with them. But let me know in the comments how you see the next few months panning out, because this is the time when some very important grand decisions might have to be made by the government.